I recently asked whether Apple, AAPL, should rethink its M&A strategy, which, for a long time, has been to only buy smaller complementary assets that can enhance its existing business. With an estimated $245 billion in cash on the balance sheet and another $76 billion in operating cash flow, there's not much Apple can't buy. The company, which is set to release second quarter fiscal 2019 earnings results after the closing bell Tuesday, has enough cash that would rank it in the top 10 of the most valuable companies in the S&P 500 index. And buying assets to grow the top line has proven to be a fruitful strategy for decades. Apple has been successful without my input. But Apple's growth is slowing. I'm not holding my breath, however. But with the stock stalling, down 6% in 6 months, investors want growth any way it comes. This is one of many topics that analysts will ask about on Tuesday. The company's recent patent licensing agreement with Qualcomm, will be another major topic. Apple and Qualcomm, which were in a long-standing patent license dispute, reached a 6-year license agreement. Effective as of 1 April 2019, including a 2-year option to extend, and a multi-year chipset supply agreement. This means when it comes to the push for 5G, both companies realized they need each other. But this agreement came after Apple explored all options, including buying Intel's INTC chip business, according to the Wall Street Journal. This deal would have been to, presumably, develop its wireless chips in-house and walking away from Qualcomm altogether. Analyst will try to unpack all of that on Tuesday, including Apple's performance in China, which had deteriorated to an extent that prompted the company to cut guidance in January. To that end, should Intel's weaker-than-expected guidance serve as an ominous sign? In the 3 months that ended March, Wall Street expect the Cupertino, Calif.based tech giant to earn $2.36 per share on revenue of $57.44 billion. This compares to the year-ago quarter when earnings came to $2.73 per share on revenue of $61.14 billion. For the full year, ending September, earnings are expected to decline 4.5% year-over-year to $11.37 per share, while full-year revenue of $254.89 billion would decline 4% year-over-year. The projected revenue decline for the quarter is due to the expected weakness in China, the company's second-largest market. But citing improving China demand throughout the quarter, Kathy Huberty, analyst as Morgan Stanley, expects Q2 revenue to come in at the high end of the company's guidance. The company's largest segment, iPhone unit sales, are expected to total $31.1 billion, while services revenue is projected to reach $11.3 billion. The services business, which includes internet services, App Store, Apple Music, Apple Care, Apple Pay and licensing, has been Apple's growth focus. Apple's transition into a full-fledged services company took a major leap last month when it announced a slew of new services offerings at its Cupertino campus. Investors will focus on not only how much revenue services generated during the quarter, but how Apple guides for the segment for the rest of the year. including its premium streaming video service called Apple TV.